Hello, everyone. Welcome to our Water Cooler Wednesday. Today, we're going to be talking about the draft stablecoin bill that they're actually going to be talking about it, I believe, either today or tomorrow in the House Financial Services Committee, I believe. And we're just going to discuss kind of what the baseline is of it. I think it's going to be a really good guidepost for us to see kind of what a finalized formal bill would look like. And as many of you in the call know, stablecoins are the backbone of DeFi. A lot of DEXs have liquidity pools that are, either ETH to USDC or whatever new tokens get listed on DEXs. A lot of times, stablecoins are the other side of that in liquidity pools. So they're really key to the functionality of DeFi because people, obviously, if they're involved in a space that's as volatile as crypto tends to be, relatively speaking, it's always nice to be able to jump into something that is, backed by either dollars or whatever it is. So that's what we're going to dive into today and just kind of do a quick overview of what the bill contained. It was, I believe, 73 pages, but it really reads like a lot less than that because of the formatting of it. So definitely a lot of detail, but still kind of easy to digest. So I'll have Brandon drop the link to it in the chat, and then we can, if anyone wants to kind of take a look at it after the call or follow along as we go, they can do that as well. So I'm just going to share my screen real quick. This, please hold. All right. So, the U.S. House Financial Services Committee drafted this bill, and it's meant to regulate stablecoins, which by definition are crypto assets that are meant to maintain a stable value and by pegging to a reserve of assets. So it could be traditional currencies like the US dollar. I think USDC Circle just recently released a Euro stablecoin. They have other stablecoins that are backed to gold. And then we have algorithmic stablecoins. Now, within this bill, I'll talk about it in a little bit, but algorithmic stablecoins there's a proposed moratorium on them just because of what happened with UST and Terra. So definitely something to keep in mind there. But as I was stating at the beginning of the call, stablecoins have become a very popular aspect of the crypto industry. And what happens with stablecoins will largely impact the greater DeFi ecosystem, because as I was discussing before, their use in decentralized exchanges or just as a means of transferring money across borders and things like that have a large impact on the ecosystem as a whole. So the aim of this bill is to set rules for the stablecoin market to ensure its stability, transparency, and compliance with financial regulations. So Title 1 of the stablecoin bill is to establish a regulatory framework for stablecoins, and this includes defining different categories of stablecoins and establishing the requirements for issuers of stablecoins, such as obtaining licenses, maintaining reserves, and complying with AML and other financial regulations. So the second part of this looks into establishing some sort of research framework for researching federal CBDC, a central bank digital currency, and then a briefing on a CBDC and kind of the impacts that might have as well. Now, sometimes people conflate CBDCs with stablecoins, but really they are very different, because a CBDC is going to be a much more private. It's more of a private network. Like, you don't have a decentralized network supporting it, so they can be manipulated, and there's a lot of potential downsides and privacy issues with stablecoins because they most likely need to be tied to digital IDs. But So that's why, in Stacey Ferris's digital asset hierarchy that she has created, CBDCs are a totally separate branch and apart from fungible and non-fungible crypto assets. So we kind of view them within the crypto industry as, apart from crypto, although they do have some similarities. They're not really in the same ethos. So that's what we're going to be looking at today. So some of the categories of stablecoins and the responsible parties are going to be payment stablecoins, which are going to be just a means of payment. So this would be a stablecoin that would be backed by a basket of assets and not necessarily like just the USD or things like that. Then there are federal payment stablecoins. So these are backed by USD, pegged to fiat, issued by the Federal Reserve, and used to make payments within the U.S. financial system to make things more fast and efficient. It talks about stablecoin issuers and who can qualify to be a stablecoin issuer, and then stablecoin administrators or regulators. So these are the people who kind of determine the rules that we need to play by. So one of the things that's interesting here is that it essentially starts to outline that issuing a payment stablecoin is going to be basically prohibited, and then it provides the exceptions for who could do it. So the fines for issuing a payment stablecoin, if you are not one of the exceptions that they list in the bill, is up to $1 million and imprisonment for up to 5 years or both. So they're implementing some strong penalties here if you don't take the steps to become a qualified payment stablecoin issuer. So so let me just jump back into my notes here. So one of the things that is required is actually registering with the payment stablecoin regulators. And so in order to do that, you have to submit your application, and then they have 45 days to respond to you to tell you whether or not you have a complete application, and then an additional 45 days, so a total of 90 days to tell you whether you are accepted or not. And the interesting thing here is that if you don't receive a notice within 90 days, you can assume that you are able to issue now. So until you hear otherwise, you would be able to operate without any word from them that as a stablecoin issuer, if that 90 days has lapsed and you haven't heard yet. So you need to receive a license from a federal regulator. And to get a license, you need to meet specific requirements. So you have to have a minimum amount of capital. You have to maintain a 1-to-1 reserve ratio backed by US dollar or other qualifying assets, some of which include treasury bills. Where's my list? So we've got T-bills, actual US currency. You've got a few other basket of assets, but most of them are very closely tied to what a dollar or a T-bill within 90 day with the closing period of 90 days or less. So what's next? Just here. So there has been a proposed moratorium, as I discussed before, on algorithmic stablecoins. So this includes things like UST. Now, obviously, UST isn't being used as it was before, like this time last year, right before the collapse. But these were meant to maintain a dollar-to-dollar value without the use of a backed reserve. So in the case of Terra Luna, you had Luna being burned when UST was being minted and vice versa. So the goal was to incentivize and create arbitrage opportunities for when that peg came away from the $1 mark. And so in principle, in theory, it sounds like something that's like a really great idea, and it allows for a decentralized stablecoin. However, as we saw with Terra, there was a huge collapse that happened because of kind of a black swan event, but also some manipulation on the back end, it seems like. And also, they were trying to kind of include in the reserves Bitcoin, which at the time was falling in value, and they didn't take adequate steps to kind of help maintain that peg by selling off that Bitcoin. So still getting to the bottom of all the complete details of that, but they, as a result, within this, have decided to propose a moratorium on, these algorithmic stablecoins, simply because they're deemed a lot riskier. Something like Circle that has proven audited reserves of their backings, that's a lot more stable than something that kind of is deemed that is kind of driven by the code and whether or not that code functions as it's intended to. So we did see obviously a depegging of USDC recently with the bank runs that happened in March. But we also saw that there was an overblown reaction to that, right? So I forget how far USDC depegged to, but if you did the math on the amount of reserves that were jeopardized by the bank runs, the USDC ended up being way undervalued based on that. So it eventually regained its peg. It's currently at the peg right now. But kind of interesting to see those things happen. But obviously, any of these could come off their peg if there's a black swan event like a bank run and the actual physical reserves are in jeopardy. But they're deemed to be safer, obviously, because of the risks are more known and they're more manageable. So, Title II discusses and focuses on the potential impact of a U.S. central bank digital currency or a digital dollar, which could have significant implications for the broader financial system, stablecoin market, and payment ecosystem. The bill directs the Board of Governors and of the Federal Reserve System, to conduct a study examining various aspects of a CBDC, such as its potential impact on monetary policy, financial stability, privacy rights, civil liberties, financial inclusion, and interoperability with other digital assets and payment systems. The study will also assess the possible consequences of not acting quickly, given the global competition in the CBDC space and the potential impact of U.S. engagement in international forums on CBDC-related issues. Upon completion of the study, the Board of Governors must submit a report to the House Financial Services Committee and the Senate Banking Committee within a year of the bill's enactment. In addition, the bill requires the Secretary of the Treasury to provide confidential briefing on the development of international standards related to CBDCs, covering the organizations and governments involved, implications for CBDCs, and opportunities for further U.S. engagement. Now, personally, I'm kind of not too excited about these CBDC advancements, simply because, as we've seen in countries where these have already been rolled out, people don't want CBDCs. I think there's a lot of negative drawbacks that outweigh the, because we already pretty much have digital dollars, right? We all pretty much already interact mostly with, numbers in our bank account that are being sent back and forth. Obviously, there's exceptions. We use cash here and there, but the possibilities with central bank digital currencies and the potential use cases where you could say that during a quarantine, beyond 2 miles from your house, your bank card won't work. It specifically will not work outside a geographical radius. And while that helps you control people more, there's and could be done in the vein of public health, it's limiting the liberties of people. And I think that there's a lot of kind of dystopian outcomes that could come from this, especially because in order to roll out a CBDC, you most definitely also have to have a government issued digital ID that you know, I'm more for kind of decentralized digital IDs and things like that. So that's just my opinion, and I think that we'll start to see if we do have some of these studies done. I hope that they highlight some of these kind of more dystopian potential use cases for a CBDC. Let's jump to the next slide. So, some of the pros versus the cons. So, obviously, it's nice to have a starting point to see kind of where the thinking is on the, the drafting of potential regulations on stablecoins. We obviously want more clarity, so we know what the rules are that we have to play by, right? So, by establishing clear definitions and regulatory frameworks for stablecoins and their issuers, the bill would provide a much needed clarity for businesses and investors that are operating within the space, right? I think another key thing that I didn't quite highlight yet on what's in the bill as well is a lot of these issuers have to prominently display that FDIC insurance would not apply to these stablecoins, because I think in the past there's been some implication that maybe I forget the exchange, but there was an exchange that was essentially saying, "Oh, we're FDIC insured," without saying it. And I think that that's going to be a clear thing that's going to come out of this, is that if you're a stablecoin issuer, you have to prominently display that, hey, this is not FDIC insured. Your money, if it gets lost or stolen, it's not insured by the FDIC. So then another pro here is consumer protection. There's looking to establish strict oversight on the licensing of stablecoin issuers. And this would help protect consumers from potential fraud, mismanagement, and losses associated with unstable or poorly managed stablecoins. Part of the evaluation process is deeming, is the company that is applying to be a stablecoin issuer, do they have the qualifications? Do they have the experience necessary to be able to run a business in this way? Financial stability. So by regulating stablecoin issuers and imposing a moratorium on certain types of riskier stablecoins like algorithmic stablecoins, as we talked about before, the bill aims to promote financial stability within the digital currency market. So this could help reduce large-scale disruptions, such as bank runs or systemic failures. And I think that, for me, if we provide clear regulation on stablecoins, the most in-demand stablecoins in the crypto asset market are US denominated stablecoins. So I feel like you can almost have a de facto digital dollar through some of these stablecoins. And with companies like Circle being US based, I mean, there is a lot of control that the US government can impose over those, whether that's good or bad. I think that you can almost have some stablecoins be de facto CBDCs without needing to have these kind of more dystopian systems. So that I see as one of the cons as well of some of this regulation, is that obviously there is some, I think it's extra, sorry, what's the title? Extraterritorial rules in here as well, where you're looking at these companies that are stablecoin issuers, as long as they're issuing US denominated stablecoins, they're going to need to either have an exemption or they have to be US based. So that's another thing that we're looking at with this. So there's going to be enhanced AML, so anti-money laundering compliance. So the bill emphasizes the importance of compliance with AML and countering the financing of terrorism, so CFT regulations. So by holding these stablecoin issuers to high standards in these regards, the bill could reduce the potential for stablecoins to be used in illicit activities. So this would also help promote the U.S. leadership in digital currency. So by taking a proactive approach to regulating stablecoins and exploring the development of CBDC, the U.S. could position itself as a global leader in digital currency innovation and policy. And then this also encourages global coordination. So the bill acknowledges the importance of international engagement and cooperation on these issues and on issues relating to digital currencies. So by participating in global forums and working with other countries to develop shared standards and best practices, the U.S. could help create a more stable and harmonized international environment for digital currency markets. So, and then just real quickly, some of the main cons would be, if the regulations end up being too strict, it could stifle innovation a little bit. So additionally, imposing the moratorium on certain types of stablecoins could create a slower adoption of different types of technologies. It can limit financial inclusion. So while the bill aims to promote financial inclusion by studying the impact of a CBDC, overregulation of stablecoins could limit access to financial services for unbanked and underbanked populations who could benefit from using stablecoins for remittances, state savings, and everyday transactions. So, cross-border payments are a huge use case for stablecoins. So, limiting or overregulating them could harm the greater stablecoin market and the digital asset market. So this could cause fragmentation of the market. The bill's specific focus on stablecoins might lead to market fragmentation with different sets of regulations for various types of digital assets. This could complicate compliance efforts for businesses operating in the broader cryptocurrency space and create confusion for users. So, and then finally, the uncertain impact of CBDC. So the development of and issuance of a CBDC could have uncertain effects on the financial system and stablecoin market. While it could potentially enhance financial stability, it might also compete with existing stablecoins and lead to further regulatory challenges. So I think it's important to strike a balance between establishing regulations so that we know the rules that we have to play by, while also, it's the age-old dilemma, right? You don't want to overregulate so that you stifle innovation, but you also want to provide clarity and guidance. So those are the main points that I wanted to take from this, and I just kind of wanted to open up the floor for discussion on this and just kind of talk, if anyone has anything to add on this thing or what they saw from this, if they were able to take a look at it, or just any kind of thoughts on this.
It's just a draft bill at this point, so you got to expect there's going to be a lot of it's going to end up a lot longer with a lot more nuances, and some of these concepts will probably be totally removed with new ones added. So, it's just a starting point. But overall, what does everybody think about just the sense it gives you if you had to just say it looks good or looks bad? Kind of the moratorium thing's kind of throwing me a bit.
I kind of expected a moratorium or something like that because of the disruption that the Terra collapse had on the market. I think that having you obviously want to create space for people to continue to innovate within the digital asset market, but and I'm not saying that I'm not saying there's no place for algorithmic stablecoins, but in the moment, I think that that's going to be a key thing that they're going to want to focus on, just simply because of the damage that caused. Because UST got huge, and it was like, I forget the total market cap of it, but it was a lot of money in there, and a lot of this whole, a lot of the collapse with FTX and some of the other major exchanges was precipitated by, there was also, don't get me wrong, there's tons of problems with FTX, and they probably would have collapsed anyways. But they had a lot of money and a lot of interest in UST, and there was a lot of cascade effect that happened from that. So I'm not too surprised by that. But does anyone else have any thoughts on that?
You're muted, Jeff.
Hey, Jeff, you're muted.
I think USDC was a huge issue too, because they were going to try to push through real stable coins backed one by one, that did all the reserves and everything properly. So that I think caused a huge setback in saying like, well, if that could be pegged now, like what do we even consider stable coins? We were actually in DC from we're part of the Chamber of Digital Commerce, so we were like in the senator's office talking to like Kristen Gillibrand's office, who's working on this bill, and they were actually going to talk to Senator Warren on this, but they were really optimistic until USDC collapsed. So there's a good chance that this bill just gets totally denied or needs to be tweaked left and right. But yeah, I don't know. It's probably not a good time for stablecoin and trying to figure out regulation when even the most concrete stablecoins collapse even for a couple days.
Yeah, that was definitely a setback for sure. To me, like I know it's hard for the general public to take this view, but for me it was like seemed like more of a traditional bank and a TradFi issue. But that's also
that's what they're pushing. That's what they're making very clear. This wasn't a stablecoin issue; it was a banking issue. And since the bank collapsed, they had their funds there. They're basically saying banks aren't safe to keep your money in. We need to figure out a different form for crypto and stablecoin to maintain their reserves because banks aren't safe. And that's what they were pushing.
Yeah.
Because they're supporting it. Warren's not, obviously. And, it's just a big push and pull and trying to say who's to blame for all this stuff. Guys, I have to drop though, but great session.
No problem.
Yeah. Thanks for joining us.
I actually had a question. I'm not sure if it's for you or maybe Lourdes could weigh in if she's familiar with this. I was just wondering, like, any potential conflicts or like tensions that could arise with the proposed regulations and the existing like federal AML laws, sanctions, and just other financial crimes regulations that are currently out there now.
Thanks, Brandon. Hi.
Hi.
Sorry, I'm trying to fix my video, but it's not working. Off the top of my head, I don't have anything, but give me a few minutes to see if I can think of something and I'll respond.
Cool.
Yeah. So, I mean, I think from, obviously within DeFi, there's, I don't think they addressed it specifically in this bill, but, if there was to be, KYC, AML requirements imposed on decentralized exchanges or other DeFi, like other dApps, decentralized apps, I think there would be a lot of challenges. Although if you had KYC AML built into something like USDC where you had to kind of KYC, I think that would provide like, I guess, either additional insights and additional ease of KYCing on DEXs. However, how do you impose these on a global basis when you have decentralized applications, right? Like, I know that in the other bill they were talking about how essentially if you're looking at each individual part of a decentralized application, if any two parts of those are run by one company, they can see it as centralized. So they could impose kind of stronger regulations on those. So I think that there's going to be obviously a lot of challenges if you require KYC on every DEX, because how do you apply those on a country that doesn't necessarily require that? Because we don't know, like they're decentralized, so they don't have one set jurisdiction. You could say that it has jurisdiction, but ultimately that could just be okay, there's a majority of nodes are being operated in the US or things like that. So I think it's going to be a lot of challenges with AML. Now, if they imposed it on the stablecoin issuer and said that, go ahead, Lourdes.
Taylor, I'm glad you brought that up because while I was thinking, you mentioned which country. Every time I deal with a client, they're sharing their products and services to me, the first question I ask them, where do you want to provide your service and product? You are a US-based company, but they say, oh, we want to provide it in somewhere in Africa, the Middle East, Asia. So this law is great, but like you said, it depends on which jurisdiction, right? So, it gets challenging because they keep asking me, I'm like, I can only speak from a US perspective. You got to reach out to your legal team in Asia, Africa, the Middle East, and in the United Kingdom as well. Because as you know, thanks to Brexit, United Kingdom has a whole different ball game. So I'm glad you brought up global.
Yeah, I think that it's important to look at, right? Because I mean, while a lot of countries will probably fall in line with whatever the U.S. says, the BRICS nations are getting more and more kind of they're coming together more and more. So if any of them don't want to have to comply, they have a stronger coalition to be able to say no to that, and they're not really as sanctionable, I would say.
No, true, Taylor, because I always remind my clients, they have these startups. I'm like, because you're a US registered company or you're licensed in whatever US state, US laws and regulations will trump whatever is happening in other countries because your company is a US company. Then I have a challenge with another client who's registered and licensed in Lithuania. Headquarters is based in Lithuania, but they're offering products and services in the United States. And I keep reminding him, yes, I understand you're licensed in Lithuania, you're registered in Lithuania, you're headquartered in Lithuania, but if you're offering products and services in the United States, I promise you, US laws and regulations and rules are going to trump Lithuania and MICA. And they don't like to hear that, but a US dollar, or if you breathe in the United States, our laws are going to trump, especially with crypto.
You're absolutely right. Did you have another thing you wanted to add, or are you just
I hit the wrong button.
Okay. Yeah, I mean, it's important. I think, obviously, yeah. So Brian says, is Bitcoin, is Ethereum a security or commodity? I don't know if anyone saw that exchange from yesterday, but I forget who it was, but he was trying to pin down Gary Gensler on providing clarity on that. And I know some people seem to think that there's been clarity on for these exchanges to be able to comply, but I think you'll see Coinbase use that exchange as a means to kind of argue that, hey, we've been trying to play by the rules, and these
It was
yeah.
it was the chairman of the Financial Services Committee.
Yeah, I forget his name though. You know his name?
Patrick McCarthy.
That's right. Okay.
Yeah, he just ripped him. Him and Emmer.
Did you play that video, Brandon?
Videos. Yeah, it was really good. Him and Emmer and the one guy that also, I don't remember the guy that wanted to create the bill to basically fire Gensler and replace him with an executive director that reports to a board. But those 3 videos went viral, and yeah, it's warmed my heart that at least some people in, or at least the Senate and committee chairs or chairs in Congress understand that Gensler's like wielding this power, not just in crypto, but I think they were talking about some other areas as well. But it at least shows that the U.S. is not, like, let's say as a governmental stance taking what Gensler says and just agreeing with it across the board. So that was like, I'd say, like, at least heartwarming from a crypto perspective, where you're like struggling to just like get a bank account or anything like that in the U.S. So it's good to see that there's some pushback from Congress about what Gensler's doing.
Yeah, if you haven't watched the full video, I think it's worth the watch because, yeah, I mean, he keeps kind of pushing Gensler on whether or not ETH is a security or a commodity, and he keeps saying that he doesn't want to speak to any facts or circumstances on any of the 15,000, and he's just like, I'm just talking about Ether. I'm not talking about anything else. So, yeah, I mean, I think that what happens with Ether will impact the stablecoin market as well, because obviously a lot of stablecoins are hosted on Ethereum or on layer 2 solutions. So obviously all layer 2 solutions need to roll back up to the execution layer or the consensus layer. So it's really important what happens with Ether as well, kind of will have an impact on the stablecoin market as a whole. So yeah, does anyone else have any yeah, and yeah, I just wanted to quickly highlight, yeah, with regards to Lourdes's comment in the Q&A, yeah, always defer to legal. With any of this stuff, we want to make sure that they're included in these conversations, because ultimately, yeah, it's gonna, no, I mean, I'm not a lawyer. I can provide the accounting and tax guidance on this stuff, but you need to be working in tandem with the legal team to kind of develop answers to these questions. So.
Speaking of lawyers, I mean, if I was a lawyer and I was defending someone who there was a suit against for, not complying with the SEC or the Commodities Exchange, then I would just play this video in court and say, well, if the government can't tell me what rules I'm playing by, then why am I here? But I'm not a lawyer.
But Brian, don't forget, that's SEC. Then we got Treasury Department to deal with.
Exactly. I thought it would.
Then you got the FBI to deal with.
Mm-hmm. Yep.
But I hear what you're saying. I
guess
Yeah, I thought that was great. The fact that the U.S. is basically not making a decision right now, kind of a crucial point where, and otherwise, right, a lot of companies are just going to go international and right now because of Circle and a few others. So, it's really kind of a critical juncture currency or not, because from my viewpoint, it's getting to the point where those legal fees are just too have your entity set up really within the United States primarily.
I always remind my clients, not only do you have regulators to deal with, you have law enforcement to deal with, because both of those big brothers and sisters are watching you. They always think, oh, we'll deal with regulators. I'm like, not if you piss off the FBI. I'm just saying.
You're absolutely right. I mean, yeah, you got to make sure that you're not only complying with what the regulators say, but you don't want to piss off those people that can come and knock down your doors. So, I think that some key takeaways here. Don't piss off the regulators. Don't piss off the law enforcement. Try not to piss anyone off, really. But I think that it was really interesting to see Coinbase's. I saw an Unchained podcast with Laura Shin. Her podcast is great for those of you who don't listen to it. And she was talking with the chief legal officer over at Coinbase, and she was asking him what was in the Wells notice that they received from the SEC. And they were like, they didn't specify what they're suing us for, which is just so hilarious to me that you can kind of at that level indicate that you're suing a company, but normally in the Wells notices, I thought you had to state what they were doing it for, and so just kind of interesting to see that take, and then see Gensler juxtaposed here, not being able to answer that question or not wanting to give an answer. So it'll be interesting to see how this plays out, and it did, like Joey said, it gave me a little bit of confidence seeing him not answer that question as well, just because obviously he's being careful about what he says, because maybe there's something else going on or another bug that's in his ear. So
I had another thing I'd like to know. The bill asks for the bill is requesting the study on the CBDCs and the influence and the development and adoption. But how do you think that'll affect the development and adoption for other countries, like China and the EU, and if they're requiring this study here? Do you think that'll provide more competition? Does it make it a crazy? Oh.
Well, I mean, China's already developing a digital yuan. I think it's already in process of getting rolled out on a trial basis. So, I mean, China's doing it. They're, and I think that what was it? There was an African country that rolled one out, and it had like 0.17% adoption. And they were trying to basically pay people to try to use it. And so, I think unless it's mandated that you use it, I think there's going to be a lot of difficulty with adoption initially. But I mean, as far as competition with CBDCs goes, most companies, correct me if I'm wrong, Loris, but most countries are already in the works of developing these because they want to move with these. So I don't know if you have anything to add on that, Lourdes.
Because I support countries outside the US, and I always say, let me defer to legal before I even answer any of their questions. Because I got questions from Africa, questions from the UK, questions from Europe, and now Asia, and now the Middle East. I got a client in Kuwait. I'm like, let me defer to legal just to cover my butt. And also, as a CCO in the US, I also defer to the money laundering reporting officer in that particular country as well to see what they're being said, which is one of the reasons why I always encourage people when they build compliance programs to have country managers in each country to continue monitoring those laws, rules, and regulations. So when we have questions, we can defer to legal and the country manager and the money laundering reporting officers. I hope I answered your question.
No, that's great. Yeah, I mean, I think that I mean, I think that they're all coming, especially in I mean, obviously in China, and I think we'll see how that rollout goes.
Yeah, I just thought it was interesting because if the bill requires, the research to be public, I mean, if you look at every country as competing companies and this one massive company that pretty much, like we spoke earlier in the call, regulates most of the world's financial markets. And you know what I mean, where these other countries / companies are able to see what's happening. I mean, it definitely levels the playing field, increases the competition, and just opens up more doors. So don't really know how I feel about it, but it is what it is.
Yeah, I think the states are uniquely positioned in that because there are so many stable coins out there that are already in existence. If the states decide not to go in the direction of a CBDC, they kind of are uniquely positioned to already have a de facto or multiple de facto CBDCs with Circle, or obviously Tether's not in the US, so that wouldn't be a de facto CBDC for the states, but we're kind of uniquely positioned in that realm. So of all countries that are developing them, we this is my opinion, we could be one of the countries that doesn't necessarily need one. I don't think any country really needs one, but I don't know. I'm obviously on the AML side, it would be beneficial, but from a privacy standpoint, I think that I think that we're one of the few countries that would have basically a de facto CBDC with USDC or something like that. But this is interesting to see the initial developments on this. We'll keep following as items continue to develop with this. I forget the exact time of this meeting. I think it's happening today. I'm not positive, but I think it is happening today. So we'll look at the recap and see what they talked about then. But I don't know if anything else they'd like to add, but not, we'll see you guys next week. Thank you everyone for participating in the discussion. I think this is a key topic and something that we'll keep watching, because as I said before, it impacts the entire crypto ecosystem. Stablecoins are like the backbone of DeFi. So we'll see how this moves forward.